Okay, so welcome back to day two. And we're going to start here with the bullish pause that refreshes, right, which is part two in a sense of the the amplifiers within stages 1 and 3. So yesterday we talked about the buy setup, the sell setup. Then we looked through all the amplifiers in stages 2 and 4. We talked about major support and major resistance yesterday to cap things off. And here we are today talking about the bullish or bearish pause that refreshes. And what we need to understand, right, is following up on what it is we're talking about to kind of bring things back in. Stages 1 and 3 are sideways stages, and they have different characteristics that we look for to determine, which is it. As we talked about, though, you can never go from a stage 3 into a stage 2. If it's a stage 3, then the next stage is going to be a 4. And so to a certain degree, you don't know that it's a stage 3 until you get the breakdown. Because there are times where price will be going sideways and then break out, which is what you see on this slide here. You can have price moving up in a stage 2, it goes sideways and then breaks out again. So when you get that breakout and continuation of the prior trend, that is a pause that refreshes, the prior move. Okay? So if it, as I said, is continuing a move in the direction of the prior trend, then it's a pause. And the same can be to the downside. So you might be in a stage 4, you have a sideways base, and then it breaks down. All right. So that is going to be the primary difference between a bullish pause that refreshes in an uptrend versus a stage 3, or a bearish pause versus a stage 1. Right? So at the end of the day, the bottom line, the thing to remember is that when price is going sideways, you don't really know whether it's a pause or a stage 3/1, depending on the trend, until after the fact. However, we do have certain characteristics that we look for to determine whether it is more likely a pause versus, say, a stage 3. So what are those characteristics? Well, with a pause, they are generally narrow, thin bases as opposed to wide and whippy. The volume is usually light within the base, aka continuation volume, right? That's what we talked about yesterday, is that continuation volume where it's diminishing within the base, indicating digestion and consolidation. And then the other characteristic is that it's moving sideways, price is moving sideways into the rising 20 MA. Whereas with a stage 3 or a stage 1, you'll have price overlapping or intersecting those moving averages. So those are some of the characteristics that you want to be looking for to say, is this more likely a pause or, in this case, a stage 3? Okay. Now, what we're looking to do as far as entry is considered is buy the breakout, buy the break above the top of the range. Now, some may ask, well, couldn't I buy at the bottom of the range off of major support? And you could do that. However, there's no guarantee that it's going to break out right after you enter. I mean, you might have entered, say, over here before it actually breaks out. You just have to be patient enough. If you believe this is a pause, you have to be patient enough to sit with it. Okay? That's the only caveat, is that if you are going to buy it down here off of major support, then you need to be patient and wait for it to actually break out before you look to then adjust your management. All right. So here is an example. And again, remember, here on the upper left, you've got the pause versus a stage 3, those characteristics that differentiate the two. Pauses are generally narrow. Stage 3s are wide. So you can see here, after a strong run up, you've got this tight sideways consolidation. So the bars are small as opposed to a stage 3 where they're generally much wider. The ranges are much wider. And the volume here is also light, relatively speaking, within this consolidation, as opposed to a stage 3 that will generally see greater amounts of volume because there's greater indecision. And then, of course, also the rising 20 MA, right? We're going sideways into the rising 20 MA, which is another indication that this is getting ready to break out, and we're going to look to buy it above the top of the range. So again, as close to a penny above the top of the range as possible. And I mean, look, you should be using the highs, not just the body, but the highs of this consolidation as your signal to buy the breakout. So you find the highest point within the consolidation, and that will be your entry point, a penny or as close to a penny above as you can get. And then your stop will go below the bottom of the base. Or if you want to get it tighter, you can use, as it is shown here, this level underneath the breakout bar. You can do that, especially if the breakout bar closes strong like this. You might initially start with it at the bottom of the base. Then as it closes as strongly as this did, you can bring it on up to under that candle's low. But in any case, it breaks out and just continues to push higher in the direction of that prevailing trend. And remember again also that the reason we'd be buying this, besides the consolidation, is the fact that the larger time frame is in an uptrend and that it has room to continue moving higher. Okay? It's important that we understand that concept, because there are times where breakouts will look like this and fail because they are into resistance or the larger time frame is bearish. So again, keep in mind that you're always checking the larger time frame as well. Here's another consolidation where you can see we're in an uptrend, nice tight range, narrow body, narrow range candles. The volume is light. We're moving sideways into the rising 20 MA. And so we look for the stock, or again, whatever it is we're trading, to break out at or near the area of that rising 20 MA. Now, that's just a general guideline to follow. The bottom line is when it breaks out, that's when you enter. Right? If it's going sideways, you buy it when it breaks out. That might happen sooner than getting to the 20 MA, or it might happen a little while after hitting that 20 MA. But when that breaks out, when the top of that range is cleared, that's when you look to enter. That's the signal. Now, as you can see, this broke out initially on the candle before, the big green one. So you would have been triggered into this on that little candle that closed with a topping tail. This is why we put our stop under the bottom of the base, and also why we need to be patient. Not every breakout is going to just explode higher once it clears the top of the range. That is, of course, the ideal scenario, but we don't always have the ideal scenario playing out. But what we need to understand is, at the end of the day, these setups that we're taking, it's a process, right? It's a process to identify the trend, see the setup develop, and then have the patience to manage the setup through until it reaches target or stops you out on a trail. But at the end of the day, as I said, you've got to remember that this is a process. It's multiple steps that go into a successfully executed trade. And by successfully executed, I don't even necessarily mean one that works out. You can follow the plan, get stopped out, and consider that a successful trade. Because more often than not, if you take that trade, it's going to result in a positive outcome. So following the plan should be the focus. You should judge success on whether or not you followed your plan. And of course, if you are following the plan and it's not making you money, then you need to rethink what that plan is having you do. But again, the bottom line is, don't let one candle, as you see here, that closes with a topping tail after a breakout, cause you to get nervous and jump ship. You have to see the trade through and realize, look, that's not the ideal way for a bar to close after buying a breakout. You certainly don't want to see it close with a bottom with a topping tail. But what happens on the next candle? Instead of just getting anxious, getting nervous, and getting out, what happens on the next candle? Let's see if buyers are going to step up here. And sure enough, they do. And then a lot of that worry is relieved on that very next candle as it then gets going and continues pushing up. But again, I just want to reinforce the point here that don't let one candle define whether a trade is going to work out or not, especially once you've entered it. Okay. So here we have an intraday pause where you get a gap up, sideways consolidation. Notice this does not quite reach the 20 MA. And it is for this reason, again, that I mentioned, don't define your entry based on getting to the 20 MA or not, right? If you wait for it to get to the 20 MA, then you're basically saying the 20 MA is what determines your entry. It's not. It's the breakout or breakdown if it were the case, but it's the breakout that determines your entry. Once we clear the top of the range, you enter. And you put your stop under the bottom of the base, manage it on up. Now, as it says here, you can project the base upwards to give you an idea of where you might expect your target to be. What does this mean, project the base upwards? So, and again, this is not scientific. It's a very loose way of determining where this might be able to go. Of course, you could just look to the left and say, okay, well, where's the next reference point of resistance? But the other thing you could do is measure the size of the consolidation. So you measure the distance of the consolidation and then basically project that upward. So you essentially just kind of extend it up, and that gives you a loose target idea. Okay, so you're basically just measuring the size of the base and then lifting it upwards to project where this may be able to go. And look, it's, as I said, not scientific, but it does have a pretty good track record of giving you an idea as to where it could go. Of course, like I said, you could also just look at the larger time frame and say, okay, where's resistance? But this is another way of getting to a similar conclusion or answer. And then at this point, it gets climactic, right? Multiple bars up, it gets climactic. We'll talk about the climactic setups later today. And then begins to pull back. Now, while this pullback does form a buy setup, it's not one that I would be looking to play for two reasons. The first reason is, and again, we will review this later, you do not want to buy the first PBS following a climactic buy setup. Okay? So again, I'll repeat that later here today, but you do not want to buy the first PBS following a climactic sell setup. The other reason is the fact that this is now pulling back and it's 12 o'clock, right? You just had a really nice run higher. It's lunchtime. It's not the best time to be entering new trades, especially if you had just gotten that run higher. And that's another question you should always ask yourself. If I caught any of this prior strength or weakness, whatever the case may be, if I caught any of this prior strength, would I be interested in buying it here at this point now? If the answer is no, well, then don't take the trade. If the answer is yes, then by all means, go ahead and take the trade. But that's a good question to just ask yourself. You know, if I got any part of the prior move, would I be looking to get involved now? Or if it was a friend, you know, if a friend had caught the prior move, would I be encouraging them to go again with this? Would I be telling them to take it again? Here's another example where you've got price moving up within an uptrend, going sideways, nice tight consolidation, narrow base, volumes light. You look to buy the breakout. And notice here, the time of day in this scenario is much better. Okay, it had made a run up at 2 o'clock, consolidated for about 30 to 45 minutes, and now it's breaking out here right around 3 o'clock, which is a reversal time. So that's a really nice setup right there. These are some of the things that you look for at the end of the day. You know, when you're coming into 3 o'clock, these are some of the things to look for. So you could do scans for stocks trading at or near the high of the day or the low of the day. And that'll bring up, hopefully, depending on the quality of the day, bring up scans or names that look something like this that you can then look to play as an late day breakout, which is something else we'll talk about later here today. But this is, again, something that you can definitely scan for, just looking at what's trading at or near the high and low of the day, and it'll hopefully bring up some good quality looking consolidations like this. And then, of course, you buy the breakout. Once it clears the top of the range, your stop goes under the low, and then you manage it on up. So it's pretty easy to see. Right, here's another example. It's pretty easy to see a pause that refreshes versus a stage 3. Generally speaking, they're fairly easy to differentiate between. Not always. Sometimes it's harder than others. But when you see a tight consolidation like this, you know, that should be getting you excited, because the opportunity to get on board for a continued move of the prior trend is becoming more and more likely. So, you know, you again buy the breakout, stop under the base, gives you a really tight entry. Obviously, it gives you a really tight entry, and your reward to risk is phenomenal. I mean, you're risking what, 10 cents to make what could be 50 cents, depending on, of course, the price of the stock. But it gives you a tight consolidation like this that you would expect to see exploding higher, gives you some really nice reward to risk. Now, I also want to point out here that when this triggered, that first bar did once again close as a topping tail. So there was a little bit of uncertainty that was created based on that. However, buyers stepped right back up and we continued higher. So I just want to point that out because I don't want you to let one bar define whether or not the setup is going to follow through. It's about taking it one step at a time. Yes, this topping tail is not how I wanted to see it close, but let's see what happens next. If on the next bar, this topping tail has no follow through, then it tells me demand is strong and that we should continue following through in the direction of this breakout. All right. Now, before I move on to the next slide, I do also want to point out this buy setup that formed. You may have already recognized it, but I do want to point it out because it is a good buy setup. And it's basically combining the prior day's action with the new information of the day. So this, right, this vertical line here, this breaks one day from the next. So we see that at the open, we get a real strong wide range bar pushing up. Price then pulls back multiple bars into the rising 20 MA. You've got minor support to the left, bullish changing of the guard, narrow body or narrow range bar, 40 to 60% retracement, right? Everything that we talked about, everything that we want to see, more or less. So that's a really good setup to look at entering long above the high of the changing of the guard, stop under the low, and then you manage it on up, right? So that also was a very nice setup to have considered. Here we have a pause that refreshes, but now to the downside. And what I will say is it can be more challenging to identify or determine a pause versus a stage 1 as opposed to a pause versus a stage 3, right? Because a stage 3 does tend to be more volatile than a stage 1. So there are certain clues that we look for to help us. And again, one of the biggest is going to be the moving average. If price is staying below the moving average and just going sideways into it, that is going to be one of your clearest signals that the trend should continue. Once price starts to overlap and intersect the moving average, once you start to see that moving average leveling out, then you start getting into more of a conversation about, well, could this be a stage 1? Are there reasons that this could be a stage 1? And so what are those reasons, or what could be those reasons? Is there support to the left? Right? Because if there's support to the left, then there's reason for buyers to be stepping up. Is the larger time frame bullish? Is this now, or has this now pulled back from a micro stage 4, and this is now setting up a micro stage 1 before the larger time frame gets ready to push higher, right? So those are some of the questions that you want to be asking to also help in your determination as to whether it's a pause or a stage 1. In any case, looking at this example, you can see we're going sideways after a stage 3 leads to a new stage 4. Now, before I even talk any further about what happened over here with the breakdown, look at what was happening up here. Okay? Because this was going sideways in a relatively tight range. I mean, it's not as tight as some of the other examples we saw, but it's going sideways and it's above the 20 MA. So could we have considered this a bullish pause that refreshes? Yes or no? You guys tell me. Would it have been wrong to look at that as a bullish pause? Right, it never broke out, so it would have never triggered. It would have never triggered the breakout. So we would have never entered the trade, but it wouldn't have been wrong of you to say, well, hey, if it breaks out, I'll look to play along because it is still consolidating above the 20 MA, right? Yeah, the volume is on par with average, but it wouldn't have been wrong of you to look at that and say, you know, if it breaks out, I'll look to buy it. That being said, if the weekly chart was into resistance or suggesting that it needed to pull back, then we would have been more reluctant to have been looking to get involved with it long. But I just want to point out that you would not have been wrong in looking at that and considering it for an entry if it were to break out. Of course, we don't have the larger time frame as a reference, but that would obviously be a consideration. But I just wanted to point that out as well, right? So in any case, what we know now with this breakdown that happened is that this is in fact a stage 3, right? This is your stage 3. Here's your stage 2. We break down. Now you're in a stage 4. Price is going sideways in a tight consolidation into the declining 20 MA. You short the breakdown, right? Once price breaks down, you short it. Now you're in it. Stops above the top of the range here, and you're managing it on down. Target area being right at and below the $32 level. 1, because it's a whole number. 2, because if you look over here to the left, you've got support. So that's a likely area where price is going to try and stabilize. This is an area where buyers will try and step up. Okay. Now, I do also want to say that you could have shorted this breakdown right here. When price broke down here, that could have been shorted as well. After we cleared the bottom of this base, once we broke down there and we see it failing to move higher, we could have been looking to short that breakdown as well. Here, once again, now see, on this slide, we actually can see both taking place. You've got your break to the downside, starting a new stage 4 downtrend. We then go sideways into the declining 20 MA. So you can see here where your entry would be on the breakdown. Your stop would be over the high, and then you're managing it to the downside. And you could have just played it for this one day, or maybe, depending on what the daily chart was looking like, you could have held it into the following day, or at least part of the position you could have held overnight if you liked how the daily chart was finishing. In any case, it does continue to fall lower the next day. Then we start to see it going sideways here. And once it reaches the 20 MA, right, you see that it's still struggling to follow through lower. You get this bearish candle that doesn't follow through. Buyer step right back up. Then it breaks down right here, and it pops right back up as well, and the volume is increasing. So there are subtle indications taking place here that are suggesting this could be a stage 1, right? You can see that the 20 MA is beginning to level off. It's going sideways here now as opposed to continuing with a nice downward slope. So that's a clue. You've also got these red bars that are not following through. And again, the volume's popping up. And of course, we don't see the larger time frame, but it's very possible that this is your micro stage 1 within a pullback that's taken place over the last, day and a half, and now forming a buy setup. So as it says, you could be, assuming the larger time frames are in fact bullish, you could be looking to buy a breakout here with a stage-to-stage match. Same thing here. You can see again, stage 3 into stage 4. You get your retracement. So this, you don't have necessarily a pause, but what you do have is a sell setup, a pristine sell setup back into the declining 20 MA bottoming tails having no follow through. So this is something that you could look at getting short based upon. You get a nice move to the downside, and then here you see price going sideways. And again, one of the clues without looking at the larger time frame, because looking at the larger time frame is going to be a big piece of the puzzle. So don't forget to do that. But just based on the action we're seeing here, the moving average is leveling off, the volume starting to increase, the breakdown that happened earlier right over here did not follow through, right? So we are seeing signals that there's clearly more demand here than there was before, and that the odds of getting some kind of move higher are increasing. All right. So the sell setup is the break at stage 4, not the first break at stage 3. Right. The sell setup is right here. Okay. This is the sell setup. This gap down, right? That's just your breakdown into what should start a stage 4 downtrend. So, look, that's not to say that you couldn't have been shorting this breakdown, not from a 15-minute chart, but if you were to go to, say, a 5 or a 2-minute time frame, after we see that this stock is going to be opening lower, we look to sell it short, under a 5-minute low, under a 2-minute low, because we know it's gapping down and igniting a new stage 4 downtrend. All right. So yes, you could have shorted here, but this is your first sell setup. You're welcome. All right. So does anybody have any questions as far as the pause versus a stage 1 or a stage 3 are concerned, or anything for that matter? Because that's the end of this section. No? Okay. Awesome. You got a question? Okay. Do you find that you get faked out a lot with these types of setups? There are times where you will see fake outs occurring. As I said before, though, if you're looking at the larger time frame and using that as your guide, the likelihood for those fake outs to truly be fake outs is lower. So what I mean by that is you might see times where, as we saw in some of those earlier examples, where that first breakout closes with a topping tail and it tries to shake people out only to then continue higher. So that's where using the larger time frame to your advantage is so important, right? Making sure that you have the larger time frame in your corner will help give you the confidence to sit through, a topping tail if it closes in that way following a breakout, or a bottoming tail if it closes that way following a breakdown. If you know the larger time frame is in your corner and that price should continue moving in that direction, then then you should be comfortable and confident with that. Having said that, I do prefer playing the buy setups, the sell setups, as opposed to breakouts and breakdowns, because there can at times be a greater likelihood for breakouts and breakdowns, not necessarily to fail, but to dance around a little bit more. You're welcome. Do you have real-time trade examples? We can definitely look through some charts either later today, or if you have any that you specifically have in mind that you'd like to look at, we can definitely take a look at those as well. There'd be no problem doing that. All right. All right, guys. So we'll take a quick little break here. I got to load up the new set of slides, so it's a good time to take a little break. I mean, it's also just getting everybody going here. So we started off with a nice kind of ease into today's material. So if you want to take a little break here, we'll do that. You can again refill that cup of coffee, tea, water, what have you, and we'll get started here in just a couple minutes. So let's take if you're gonna get some coffee or tea, we'll take 10, and then I'll have these slides loaded up, and we'll get started with the next chapter. Okay, so take a 10-minute break here, and I'll be back on with you, and we will be ready to start the next set of slides. Okay, guys, I'm back. Hopefully, you got me here once again. So LPSN short, is this a flat base going down? Let's take a look. All right, so you should have the chart now in your screen, LPSN. Can you guys see that? Just want to make sure before I start speaking to it. All right, perfect. So yeah, this is a nice consolidation. You can see I've got the 8-period moving average on here as well. But yeah, this is a nice sideways consolidation right up here. You could say this was your stage 3. The wide range bar broke down into what's now becoming a stage 4. And again, you've got a nice tight consolidation here. If it breaks down, you'd absolutely be looking to short this. And as I've been saying, you always want to check the larger time frame. Look at this weekly chart, right? It's pulled back. And while it's sitting on this moving average here, there's a couple things to consider. One, it came down hard, right? The angle of retracement is very sharp, and there's room for this to continue moving lower. Two, if we get the breakdown, it's also breaking down under this moving average, so it's going to, again, have clear air below, and those who are looking at this moving average and trying to step up, holding it here, if and when it breaks lower, they're going to be forced to cover. Anyone else watching this and seeing it break down, they're going to be like, okay, here we go. Couldn't hold it. They're going to be looking to get short. So the larger time frame is most certainly in your favor here as well based on this information. So it's definitely something that, again, if price is to break down here on the daily, should be a good to go short. You could even look to get involved maybe just below 11. I was going to say $11 because it's a whole number, but it's broken down below that a couple times already, and it's popped back up. So you probably want to give it a little more room. Call it under 1090 or so, and if that happens, it should be starting to move lower quite nicely, especially because of what happened on Thursday. Right, Thursday it broke out, hit a high of 1145, which did clear this prior area. All right, and what is this high here? The high there is exactly 1145. So it cleared the highs over the last couple weeks and closed with a topping tail. So that is another indication of increasing supply. So for all of those reasons, if this breaks down, it looks like it'll be a good short to take. And as far as targets are concerned, at least I'd be looking for this to move down into the 850 area at a minimum, just because it's where you have this prior support area, right into that area. And the possibility for it to come even all the way back down certainly exists. But this would be the first area that I would at least be, paying attention to see how it's behaving. Does that make sense? All right. Awesome. This is just through freestockcharts.com. So if you want, if you want to do some quick analysis, and not have to fire up the platform. You can just go to freestockcharts.com, and that's what this is. Or you can use whatever other platform you have. I also have TradeStation as well. Yeah, especially in the beginning, right? So, you could use these charts just to see the setups, and then you can use your execution platform, whoever your broker is, to execute the trades through. The only thing is that this works with Internet Explorer. It is not compatible with Google Chrome, and I don't believe Firefox either. That's the only downfall to it. All right. All right, so let's shift back over to our slides. And this, guys, this is honestly one of my favorite sections because to me it really brings together or allows you to see the earliest possible moment when the trend is beginning to change, and it'll help clear up any uncertainty as to, is it too soon to get in, or do I need to wait for more information, right? As we move from one stage to another. So to me, this is again one of my favorite chapters because the power of what it allows you to then do. The ability to get on board a trend before the majority are even recognizing that it's shifting is very powerful, as I'm sure you could imagine. And also, I forget exactly who it was that asked yesterday, but there was a question about, is there a slide that breaks down or gives you all of the amplifiers? And the answer to that question is yes. It's at the end of this chapter. So if you want to, when you're going through the manual that you have via your portal, you can go to the end of this chapter and find it there. Or if you want, I'll leave it up for a second. If you have a screen capture tool, you can use that to just grab a quick image of that. This way you can have it right here and now, and don't have to, as I said, go to your portal to access it. But just know that it is there too. Okay. So without any further ado, we'll get into power trading combos for these transitional phases. So I'm not going to read all this. I mean, that's boring for both you and I. So you can read this on your own time if you so choose, but basically it's saying everything that I just said about being able to see trends and when they're changing at the earliest possible moment, and being able to capitalize on those opportunities before, again, the majority are even aware of what's happening. And remember, I mean, the majority, they they need to wait for extra confirmation because they lack confidence in what they're seeing or in their approach, right? So a lot of times traders, they'll see, hey, here's an initial breakout, right? This is, by the way, your transition from a stage 1 into a stage 2, where you have the initial breakout, which a lot of traders will see happening. Then you get the pullback, followed by the secondary breakout. And a lot of times, newer traders especially, or traders that just simply, as I said, don't have enough confidence in what it is they're seeing, they will oftentimes let these opportunities pass them by because they need to wait for more confidence. They need to say, okay, well, yeah, I see it broke out, that's nice, and then it pulled back and it held and pushed up once again, so let me see if it can pull back here again, and maybe I'll consider buying that, or maybe I'll wait to see if it pulls back here, does it push up again, and then maybe at that point I'll really believe it's going to continue trending up, right? We've all been there, right? So if what I just spoke through sounds like something you've yourself gone through, we all have. You're not alone. So This is, as I said, a very powerful tool to understand and capitalize on. So again, you've got the initial breakout, as we discussed earlier. Breaking out from a stage one is the first buy point, right? This is an excellent buy point from both a trading and investing point of view. Now, not everybody likes buying breakouts, which is fine. I'm not the biggest fan of breakouts. That's not to say that I won't take them, but if given the choice between a breakout and breakdown or the buy and sell setups, I'm going to choose the buy and sell setups. So for me, I will oftentimes wait for the first pullback, which is the quote-unquote safest buy point, because now you've gotten confirmation from the initial breakout that buyers are taking control, right? The breakout and close above the base tells you demand is strong and that the expectation has now been set for price to move higher. So as we come back and retest what is now minor support, you look to buy that PBS. And then here, as you get the secondary breakout, as the stock or whatever it is you're trading is breaking above this prior pivot high, that you could consider buying, but really only from a more intermediate term point of view. This is not a buy point, in my opinion, if you're trading off of, say, a 2 or 5 minute or 15-minute chart, because to me, in my opinion, it's a bit late. However, if you're trading, say, off of the daily and you're willing to put your stop down below this pivot low because you believe that this stock can continue to move higher over, as I said, a more intermediate period of time, then you can do that. But the secondary breakout for me is more of just confirmation that this trend is really getting itself developed and underway. Okay, so what we call this is transitional phase A, the link between stages 1 and 2. Because everything within this circle is not yet in an uptrend. Remember, an uptrend is defined as 2 or more higher highs and higher lows. Right here, all we have is a 2 higher highs and 1 higher low. Okay, so this is not yet by definition an uptrend. However, you can find opportunities to get long within that. And so understand also that this concept can also be applied to the pause that refreshes. A lot of times you'll see the pause followed by the breakout and then first pullback before continuing higher. So it's not just something that works or can be applied to stage 1 into a stage 2, but also a pause back into or resuming a stage 2. Okay? So that's pretty much what you see here, right? This is already in an uptrend. You then have this sideways base followed by the initial breakout, which again, you can buy. And then as it pulls back, you get your first pullback where you could look to either re-enter or enter for the first time, or what some other traders might do, you might look to buy the initial breakout, sell part of your position as it moves up here, and then add to your position on the first pullback, assuming it triggers, because at this point it has not yet done so. So that's another choice that you have. Right? So we'd be looking to buy it over the high of this bottoming tail, stop under the low, and then our expected move is going to take us up through this prior high, right? So with this particular setup, as we look at it, right, if we're going to enter over the high here and the stop is going to be down here, if you have an initial target up at the prior high, do you guys see the problem with that? Do you see where I'm going? with this, if you have your target or even an initial target up here at this prior high, yeah, the risk reward. Exactly. Right? That's the problem with this. That's why I don't like having targets at the prior high. This trend is up. I'm looking for it to exceed this, maybe come up to $8.75, $9, somewhere up in that area where it becomes worth our time to take a trade like that. And quite frankly, I mean, it should be able to get there based on this setup. But that is a trap that a lot of traders fall into. It's one of those things where just because you're locking in some money doesn't necessarily benefit you, right? I know plenty of traders who in the past or even still do, they'll take some profit here at this initial target. Maybe it's 1-to-1, right? However, by taking some profit up here, you got to have a real high batting average. You got to be right way more often than you're wrong, because if you take, let's say you take, right, partial profit here, and then maybe you get a little bit more follow through and you take another, you take the rest of your profit up here, it's going to cut into your overall return, right? Whereas if you take a full stop, it's a full stop. So you really need to be aware of how you're managing positions, because that can be the difference in making money or not making money. What about moving up the stop? Could you just buy slightly lower than the top? Not sure I follow what you mean. I mean, you can definitely adjust the stop as it's moving up towards that high. Yeah, I mean, once it's up into that area, you can definitely start to adjust the trail stop so that you're locking in profit and not allowing it to pull back against you. You want to be doing it in an objective way. So you don't want to just use an arbitrary number where you're going to adjust your stop to. Um, it's got to be based on price. So if it's using a prior bar's low, that's fine. I mean, even if you just use a moving average, it's not the ideal, but it's better than just picking a number. Right? When you're managing positions and adjusting your trail stop, it should be based on support and resistance. Right? That's why I don't like break-even stops unless it lines up with price support or resistance. Right? If your goal, if your focus is trying to bring your stop to break even as soon as possible, it tells me or suggests that you're focused on not losing money. And quite frankly, that's exactly what will happen a lot of the times. You might not technically lose money based on the P&L, right? If you bring your stop to break even, you might not lose money because you're getting out break even, but you might leave a ton of money on the table. And so in a sense, that is still kind of losing money, at least in my opinion. And the only reason, you got stopped out is because, like I said, you weren't willing to be patient and let the trade develop. How often have you been stopped out break even only to see price then turn and go without you? So try not to focus on going to a break-even stop as soon as possible. It should all be based on the chart. Here's another example where we have price moving sideways after a strong move up, right? You then get your initial breakout. So you buy this if that's what your plan tells you to do. You buy the breakout at 1. As it moves up here, you can sell some or all of it. And then as you get your first pullback, right, here's your buy setup, 20 MA, minor support, narrow bodied bar, bottoming tail, right, 40 to 60% retracement, etc. You buy that buy setup, stop under the low, and then boom, off it goes. So either one or both is fine, right? It's all about what your level of confidence is with each of those setups. This one isn't as clear in terms of the first pullback being obvious, right? I mean, you can see the initial breakout, then price goes sideways here. You can see it does try and dip lower, right? You get this bottoming tail right there. So you know that there was on some level on a smaller time frame, there was a pullback. You're just not seeing it based on this time frame. However, you could look to then take that knowledge and say, you know what, if it breaks out here, this is the kind of secondary breakout I will buy. Right? Maybe I missed the first pullback because it just didn't happen on the time frame I was looking at. It happens. But I understand what's happening. I understand what's going on here. And so as I see this come up and start consolidating, that tells me, hey, you know what? We can buy this. We can buy this as a breakout for a move higher. Right? Does that make sense, guys? In another way of kind of thinking about it, what it looks like is price has moved up like so. It then pulled back on a smaller time frame. You got your buy setup. It starts moving back up like this, and then you get a little bit of a base there, right? So you're looking to buy it over those highs. Not the best drawing, but hopefully it gets the point across as to what I'm trying to explain here and why you can look to buy that breakout. Okay. So as we look at these questions here, what two moves are next? I mean, we're looking for price to continue moving up, and then probably you're going to get some kind of pullback or consolidation. Here, we had professional volume starting the move. We'd be looking for another wide range bar and novice volume to end the move. And that would also suggest that we are now likely going to see that pullback from a climactic sell setup occur. So it's pretty easy to see what we've got going on right here. You've got your initial breakout at 1, followed by the first pullback at 2. What I also want to point out here on this particular slide is that the first pullback does not always come right away, as you can see in this example. So sometimes, right, if you say, you know, I'm not going to buy the initial breakout, that's fine. You don't have to. But understand that there will be times where maybe it doesn't pull back right away, and you have to watch part of this move go without you. I mean, like I said, that's just part of what we have to accept as traders. There's nothing wrong with it. I just want to bring your attention to it. But at the end of the day, you can't possibly get every single move. So don't put that kind of pressure on yourself, right? Don't stress out about, oh, I didn't get this move up. I missed this part of the move. That's part of trading. You're going to miss moves. There are more trades that you miss per day than trades that you are able to capitalize on. That's just how the numbers work out. You can't possibly get everything. With all the stocks out there, you cannot possibly capture everything. So why worry about it? Right? Focus on what you can control, the setups that you do have confidence in, and then when they set up, when they form, you got to be ready to act. But don't stress out about missing certain moves, because not every move is meant for you. We got to spread that wealth around. All right, so transition C is just the opposite of transition A. Right? So you've got your initial breakdown from stage 3 or a pause. You then have your first pullback as the stock, or again, whatever you're trading, corrects towards the initial breakdown point. And then you have your secondary breakdown, which, again, as I said before, to me is more of a confirming signal, but as a more intermediate term trader, it is something that you might use as a signal. Or even, even if you trade options, for example, maybe you missed that initial pullback, but then you see that secondary breakdown occurring. You could say, hey, you know what? I see the secondary breakdown taking place. I know that it has room to move lower. Maybe I'll buy some puts. Right? So that's another option that you do have, no pun intended, but something to consider. If you don't want to just play the actual stock, you can trade the option there. So what does it look like? Here's your stage 3. You then get your initial breakdown, which, again, you could consider shorting. Or, as it then retraces, here's your first pullback. You can short this sell setup when and if it trades under that bar's low. And then your stop goes over the high. All right. And then, of course, you're going to look for and expect that secondary break below this pivot low to occur. Especially, look, I mean, if there's ever a time where you expect the prior low or the prior high, as we were just looking at, to be taken out, it's within these transitions. Why? Because we're just starting a brand new trend. There should be no question in your mind that we should get a lower low or a higher high if that were the case. The only time that you should start thinking that a prior high or low is not going to be exceeded is if that trend has been underway for an extended period of time and that now the void has been filled. Otherwise, you should expect that price is going to break through that prior high, or in this case, that prior low. And so this is what the expectation should look like. Right? Here's your initial breakdown. So you could have shorted that. Nice move lower. You then get your first pullback, your first retracement, and sell setup. Right? So again, you sell it short under the low, your stop goes over the high. And then again, if to our earlier conversation, if you just had your target or even an initial target at this prior low, your risk reward is 1-to-1 at best. That's not what you want to be looking for. Right? You should be looking for it to continue lower. And that's exactly what you got, a nice continuation lower before price then began to stabilize and then and then continue lower. As I look at this slide though, it does bring one other point to mind, and that is if you if you find yourself shorting the secondary break, one of the things I will tell you is that you should almost expect that shortly after your entry, you should expect price to move against your position a little bit, because the move from this high down through the prior low is 100%. In fact, it's greater than 100%. And anytime you have a greater than 100% retracement, you should expect there's going to be some kind of correction against that. Not to say that it's going to go all the way back up, but there's going to be a little bit of a correction as you get some profit taking, things of that nature taking place. So, just again, like I said, a word to be aware of, or something to be aware of, is that if you play that secondary break, you got to expect that there's going to be a bit of a move against you initially in all likelihood. Okay. Okay, so as I mentioned yesterday, we do consider trend lines. The trend line is going to receive 10 additional points within our scoring system. However, I will tell you, I personally don't really use trend lines anymore for a couple reasons. I mean, one, I just try to keep my charts as clean as I can. Number two, visually, I can see where those trend lines are. And number three, they really don't, in my opinion, give me an edge, right? Because I want to be focused on that minor support, minor resistance. So for those reasons, I really don't consider it too much. However, one other way to utilize trend lines is to help indicate or suggest when the trend may be changing, when you may be going from an uptrend into a stage 3 or a downtrend into a stage 1. All right, so before we get into that discussion, let's just cover how we are going to draw trend lines, because the last thing you want is to end up with a bunch of different lines all over your chart that you just get very confusing. We want to keep our trend lines objective. So you start by marking the major low, which is preceding or just below the highest high. Okay, so this is your major low right here in this example. You then find and mark the lowest low of the current upward move. Okay, and then you simply connect those 2 points and extend it out into the future. Now, the major low, the anchor point, if you will, this is going to change as the trend continues to move higher, right? Because if we then get a pullback and then price makes another higher high, we then have to adjust that reference point. So in a sense, a pristine trend line is always evolving. As new highs or new lows are made, the trend line is updating with that new information. So here's what it would look like if you were to use an example, right? You've got again, find your highest high. You then go to your pivot low preceding that. That's your anchor point. You then find the lowest low, connecting those 2 points, extending into the future. And so that gives you a rough estimate of, where you look for that trend to hold if it were to pull back there. Okay? The downtrend line is just the opposite. Right? You find, in this case, the major peak or the pivot high just above the lowest low. You then find the highest peak or the pivot high of the current downward move, connect those 2 points, and then extend it out into the future. And so that gives you your downtrend line. And again, as I said before, this will change as you see lower highs and lower lows made. So here you can see an example of a trend line. Now, one thing I want to point out or question, why are we not using this as your major peak? Why is that not what we're using as the major peak? You guys tell me. Anybody want to take a stab at it? And while you guys answer that, Amber says to send her hellos to everybody.
Hi, guys.
Well,
I want to see some participation.
Not because of the red bar, but because it's not a lower low. Right? Because we did not get a lower low, that's why we're not using this as our major peak. Okay? It's that simple, right? Now, if this were to continue lower and make it a lower low, then this would become our new major peak and reference point. But that's the only reason we're not using this, right? So again, as I said, a pristine trend line is different from other trend lines because ours are going to be evolving. We're not going to draw, 3, 4, 5 trend lines as new information is given to us. So the other important note or the other important usage that we have with trend lines is their ability to help provide us with the earliest possible indication of when a trend may be changing. Okay, and that's where we're going to look at and explore here now. And this is what we call transitional phase B, where we are no longer in an uptrend, but not yet in a downtrend either, right? We're in that transition from stage 2 into stage 3. So the initial break, right? You've got your trend line drawn. The initial break occurs when the stock breaks below the uptrend line. Now, it's important to note that this initial break is not an actionable event. In other words, we're not looking to short the break of a trend line. I know there are methods out there that do suggest doing that, but not here. We're not going to short the break of the trend line. It is simply a warning of a possible trend change. Okay? The reason we're not shorting the break of the trend line is because who's to say it doesn't stabilize a bit lower and then push back up and make a higher high? Or, based on what we were talking about yesterday, who's to say it doesn't pull back into the pristine buy zone, right? If it pulls into the buy zone, it's going to, in all likelihood, break the trend line, and then it continues to move higher because the larger time frame is now pushing up with a pattern. So, as I said, the initial break is not an actionable event, but instead just a warning of a possible trend change. So, as we move forward in time here, if and when we get a retest and failure, a retest of the prior high and failure to move through it, that begins to confirm so overhead supply is increasing, and it does offer an aggressive opportunity to get short. You could short the double top with the expectation that it is either A, going to move down and break through the prior pivot low, therefore establishing a very sharp transition from stage 3 into what will become a new stage 4. Or you're shorting the top of what will become a new stage 3 that just starts to chop sideways. You don't know that ahead of time, obviously, but the retest and failure is an aggressive action of event where you could look to get short. Okay? So here we can see as an example our uptrend line being broken. And when we look at an example like this, I mean, the severity of that break, it's pretty clear that this trend is getting ready to probably transition. Now, it is somewhat of an assumption on my part, but the fact that it pulled back in that way, the angle of that retracement, the severity of that retracement, quite frankly, I'm surprised it was even able to rally as much as it was, or as much as it did. But then when it comes back up to retest that high, you see the momentum slowing down, and you could look to get short up there at the number 2. And then what you'd be looking for is a move back down to the $100 area where you've got support, and then possibly even getting a break below that. Okay. Here is your transition D. So this is where you go from a downtrend into or transitioning into a stage 1. Like I said, these transitions link the 4 stages, or rather the the four stages. So from a 4, we go from a 4 into transition D into transition or into stage 1. So you go from a 4 to transition D into a 1. Now, again, it's just the opposite. When you get the initial break to the upside of your downtrend line, that is not an actionable event, but a warning of a possible trend change. It tells you, hey, things have started to transition here. There's a bit more strength than there was before. Okay. So then, as this continues to trade, as we get more information, if we get a retest and failure, if this occurs, it can be viewed or taken as an aggressive long entry, playing a double bottom. And then, of course, you're looking for price to move up, eventually breaking out, igniting a new stage 2, right? But so if we look at this, guys, right, what do we have in here? What's in that circle that I just drew? All right, so here you go from transition D into a stage 1. Right, you do have a retracement and pullback and buy setup, absolutely. But isn't this also transition A, your initial breakout above this stage 1, and then here's your first pullback, right? This is transition A. Because, right, it's not yet in an uptrend. So here you could have bought the initial breakout or first pullback as this is establishing a new uptrend. So, I mean, you guys are right in the sense that you're looking to get long. And that is ultimately the most important thing, is you're recognizing this as a signal to get long. Okay? So here's an example how it looks on a chart. Trend line breaks above. First warning that the trend may be getting ready to transition or change. Price then pulls back, retesting this support area. You get an aggressive entry long that you could consider taking. Price then rallies up to the prior high, breaks through it, and begins to exceed that level, moving into the price void as buyers continue stepping up. So as I look at this, I mean, I'm of the mindset that the larger time frame was very bullish in order for this to push on up as it did. Okay. So here are the 7 events, not even just stock market events, but anything you're trading. These are the 7 events that you need to be aware of. Either it's in an uptrend, a downtrend, or a sideways trend, right? Or it's in one of the 4 transitions. It's breaking out into a new uptrend, breaking down into a downtrend, or transitioning from an uptrend to sideways or down to sideways. Right? So if I were to draw it here, right? This is your stage 2, right? This is your stage 4. This is your 1, whoops, or 3, right? And then here, this is your transition A. C, B, and D. Right? You guys see all that? Right? Here's your stages, and then here are the transitions. This is it. This is all you have to worry about. So really, one of the questions you need to be asking yourself is, which of these 7 events is the stock I'm looking at currently in? And you ask that question through multiple time frames. And if you have them in agreement, then you've got an opportunity. Once you have the agreement of these time frames, you then, here's that, that slide that you guys were asking about yesterday, your bullish patterns, your bearish patterns, and how much they're worth. And then you've got your amplifiers, whether it's an event, location, or time. Right? So what is it occurring with? Where is it occurring? And when is it occurring? So this is, again, that slide that you want to go ahead and, either capture it right now, go ahead and take a little screenshot of it. You can do that. Or, as I said, know that you also have access to this in your portal. But this is a nice breakdown slide. Beginning of the month, the first couple days, the first few days of the month. The middle of the month is that couple days in the middle part. And then the end of the month is the final, final couple days, 3-4 days of the month. It's, and honestly, it's less about backing yourself into a corner with exact times, and more about just being aware of what's happening. That is, like any amplifier that we've discussed, the real value. It just forces you to pay attention to what's going on at these periods or moments in time. You got a question? Absolutely. Could you lose yourself in all this? I think in the beginning it might be more of a challenge, especially if you're on, say, a 1 or a 2 minute chart. It can be very overwhelming, right? Because you're trying to find all these things. Um, as you get used to it over time, it's like driving. It just becomes second nature. You see the chart, and it's just your eye over time. You've forced it to recognize these things. So in the beginning, it might be a bit overwhelming to try and be so diligent in trying to identify each one of these. It can, like I said, become a bit overwhelming, but it does become second nature over time. If you want to start with just one or two, you can. And then, of course, at the end of the day, when you're reviewing your charts, that's when you really want to be paying attention to it. That's when you want to go through and really say, do I have a bottoming tail or changing of the guard or above average volume, narrow range bar, support, retracement, etc. Right? That's when you really want to do that type of analysis, because that's when you can really start to reinforce and train your brain to look for those things. So I wouldn't suggest picking one from each. What I would suggest, as I did yesterday, is making sure or determining, maybe separating them into two different lists of what amplifiers do you need to have and which ones would you like to have. And in all fairness, that might take a little bit of time for you to determine, right? You got to get comfortable with what it is you like to see. But that's, like I said, something that'll come with time. And here's just a little slide showing different combinations. I mean, I'm not going to go through all this because we've done a lot of it already, looking at many, many examples of what the buy and sell setups look like with these different amplifiers. But like I said, I mean, one of the biggest things is just determining which amplifiers you need to have. And for me, like I said before, it's support or resistance. If I don't have that at a minimum, then I'm very cautious about entering, if I will at all, into that particular position. All right. Okay. Let's see here. Let me just take a quick look at this. All right, we'll go through this chapter here, and then we'll take a little break. We'll see where we're at, take a little break. I just see a little bit of typing here, so I want to make sure there's no question before moving along. Well, you should have access not to these recordings, but from the past recording. You should have access to that, I believe, as of right now. So if you log into your portal, your T3 portal, and under the education section there, you should see trading the Pristine method. That should, I believe, be available to you right now. As far as these actual recordings, I would say by well, probably middle part of this coming week, middle part to end of this coming week, I'd say that they're probably going to be available. But don't hold me to that. I know our IT guys have other projects going on, but that's tentative guess on when they'll be available. But like I said, you should have access to the prior recording already. All right. All right, awesome. Okay, so let's talk about the climactic buy and sell setups. We've already alluded to them on several different occasions, so it's not a foreign concept that we're now introducing. But let's really dive into the details of what it is you're looking for and what you want to see here. Okay, so the climactic buy setup is made up of 4 to 5, even maybe 6, as I'll introduce, key pieces of criteria. And it is the key to capturing gains against the trend. One thing to keep in mind with this particular setup, the climactic buy and sell setups, is that we're really not going to score it on our scoring system because it's a counter trend trade. However, all of the amplifiers that we discussed, you do still want to look for. So the volume, changing of the guard, bottoming tail, narrow bodied bar, those all still add value to the quality of the setup. But like I said, we're just not going to score it because it's a counter trend setup, and we don't want to necessarily promote going out and actively looking to trade against the trend. As we've already said, this is something, counter trend trading is something that should only make up, maybe 10% of your trading overall, especially in the beginning. As you become more comfortable and confident with the setup, maybe you add a little, you add it in a little bit more, but that should only be based on your success trading against the trend. It's easier to go with the trend. So the setup and the criteria we're looking for are as follows: 5 or more consecutive lower highs or red bars. Having both makes it better because, again, it's a more fluid overall move. It communicates greater amounts of fear. You then have some kind of bottoming tail, narrow-bodied bar, changing of the guard, or some kind of combination of those. It's also far below, ideally far below the 20 MA. You want to see some extension there. I wouldn't worry so much about these percentages that are offered. You can see visually what's far below the 20 MA or far above if it's a climactic sell setup. You also want to see a volume increase. You want to see that things have become climactic, that novice volume we discussed yesterday is in place. And if it's intraday, if you can get this setup occurring with or at a reversal time, it's an added benefit. It's not required, but it is an added benefit. And then the sixth piece of criteria, the additional thing that I would say you want to have is support to the left, right? Why is this going to stop falling? Just because it's down a couple bars? No, I mean, there's got to be a reason why traders are going to start stepping up here now. So you want to see that there is support over to the left so that you've got a reason why buyers are going to show up. Okay, so that would be the other piece of information that I would require personally. Or resistance if it were a climactic sell setup. Now, as far as how we enter, it doesn't change from anything else. We're going to look to buy a penny above the prior bar's high. Our stop is going to go under the prior bar's low, which at times the stop can be large. So you may choose to use the bar that gets you in, the trigger bar. You might choose to use that low as your stop, which is something that you could consider. Okay. So when the stop is too large, you could use the bar that gets you in as your stop. And then if the target is going to be in the area of that 20 MA, right? That's going to be your target area, is a retracement back up towards the 20 MA. So here you can see an example of a climactic buy setup. You've got your multiple red bars moving lower. They're also lower highs. You then get this big novice volume coming in, bottoming tail, ending the move. Right? So you're looking to buy it over the high of the bottoming tail. And in this case, again, the stop would be too big if you were to put it under the bottoming tail. So instead, you use the bar that gets you in. You put your stop below that low, and then you manage it on up into, again, the area of the 20 MA, which isn't here, but it's also in alignment with a little bit of resistance, not quite to that area, but just below it, right? But this is where you'd look to be exiting. As you see that supply coming in, you can see the topping tails forming. That's going to be your signal. It's time to get out. And remember, with these climactic setups, these counter trend trades, I don't suggest that you try and manage this in pieces. I wouldn't suggest that you sell a little bit here and then have a bigger target for more, because it's against the trend. So you shouldn't necessarily be looking for more. You should be looking for what you can get out of it and be happy with that. The other thing I'll say with these climactic setups is that when they trigger, they should work rather quickly upon triggering, right? If it's in the direction of the trend, if you take a trade, a buy setup, a sell setup, in the direction of the trend, then that might take a little bit of time to get going, and that's okay. But if it's a climactic setup, you don't want to give it a whole bunch of time, because this is the kind of thing where you're trying to capitalize on a move against the trend, so it should, as I said, move quickly in your favor. Okay? Can you review the recent HYG climactic buy setup and how you've traded it? Well, I can't say that I've actually traded it. I didn't, but I can offer insight into how it would have been traded. All right, so here is the HYG. And you can see here on the daily chart, I mean, it does go climactic. First of all, it was a climactic setup over here that it actually does look like it would have triggered on the daily, but it would have stopped out, right? It just never got going. And this is why, as I said, if these things don't start to go rather quickly, then you want to keep a tight leash on them. You don't want to give them a lot of room, because, again, you're going against the trend. You're going against the grain. If it's not moving in your favor quickly, then you've got to start questioning that and being, maybe this is weaker than I thought. So in any case, it continues falling. Then you get this gap down that snaps right back up, closes strong, and then it gaps all the way up here the following day. So from a daily chart point of view, there was no great entry. So what you would have had to do is go down to like a 5-minute time frame back on this day. I'm not going to have enough data to go back here, but basically what you would have been doing is going back to this day, finding a way to get on board, right? We can go to the hourly, and if I scroll this back, right, here's the day where it gaps up. It gapped right into resistance and pushed up through it. So, I would have been looking on a 5 or a 15-minute for some little pause that we could have then played a breakout on. That, or the other option, just if we're going back to the daily chart, the other option, and this is something that we can discuss also when we get into the guerrilla tactics, right? The fact that this gapped down and snapped back up when it traded above this prior day's low, you could have taken it long at that point. So that would have been another way in which you could have gotten involved with this to the long side. Assuming they don't gap, right? I mean, that's what really threw this off. There have been other charts that have gone climactic and offered some nice opportunities on the daily. But when they gap, it definitely adds another bit of a challenge. So in that sense, yes, intraday opportunities are better because you don't have to worry about that. But I mean, again, I've seen daily charts that do follow through nicely, or we can, when we get into the guerrilla tactics, talk about it in that sense as well, because it definitely could have been taken advantage of from this day here. Okay. Right, because even this example here, this is a daily chart also. Right, it just doesn't gap up as much, which is what allows you to get involved with it on that day. Next example, we've got, in this case, 11 red bars to the downside. You then see the volume coming in. You've got your bottoming tail. You see the changing of the guard and the narrow-bodied bar. So you're looking to buy it over that high. And again, in this case, if the stop here is too big, you can use the bar that gets you in. And then you're looking to sell it as it moves up into the 20 MA. But again, notice how quickly this started to move up and follow through. That again is what you're looking for. Okay, so really nice push up there. And then once it hits your target, that's it. You're in, and then you're getting out. You're not sticking around to see, oh, what is it going to do? Because remember, this is a counter trend trade. If it starts to pull back in, it could fall all the way back down. Here's a daily climactic buy setup where you've got multiple days down. You see the wide range bars coming in, the volume's picking up. Here you get your potent reversal closing really, really strong. Very bullish candle. You enter there. In this case, right, if you enter on the big green bar, your stop really, at least on the daily chart, has to be down here. But then on the next day, you could quickly move your stop up, or if you got in the following day here, right, you could use that bar's low as your stop. And then, of course, your target is going to be up in the area of that 20 period moving average, which we gapped up above the following day, which was very nice, and that would have allowed you to take a nice profit on that one. Okay? So again, I mean, these examples, you know, when they work, I want to stress that when they work, when they're clicking and firing on all cylinders, they work quickly. That's what you should expect. If it's taken a little bit of time, right, if it's taken a little bit of time to stabilize and get going, that's when things become a bit more questionable. Right? So if it's taken its time to get going, you really want to wait on it, and if you need to, just stand aside. Okay. Now here we've got another example, as you could probably guess. We're talking about climactic, so it's a climactic buy setup, and this is on the 5-minute chart. You got a nice fluid move down, bottoming tail, huge volume increase. I mean, it's very obvious that this is extended to the downside and needs to bounce. So you buy it over the high of the bottoming tail, stop either again under the low of the bottoming tail or over or rather below the high, I'm sorry, below the low of the bar that gets you in. And then you manage it up into your targeted 20 MA. Okay? Give me just 1 second. I'll be right back with you. All right, guys, I'm back. Sorry about that. So here, let's see, PYPL was a good climactic intraday we did in the black room recently. Awesome. Yeah, I mean, those guys, they crush it with those climactics in there. You know, Sammy, Ifan, Mark, they really they enjoy trading those climactics, and all the more power to them. I mean, it's not my favorite setup, but to each his own. You know, there's nothing wrong with it, and those guys do really well trading the climactics. So here's another example. I mean, this looks a bit more exaggerated because it's on a 2-minute chart. So the further down the scale you go in time frame, the more exaggerated it may look. But again, I mean, look, at the end of the day, multiple bars down, wide range bars. This is needing to correct. There's going to be profit taking. So you buy it over the high of that changing of the guard. Your stop goes under the low, and boom, off it goes. And as I said, if it's not going quickly, then it's concerning. All of these examples that we've looked at so far move quickly. And that's, as I said, what the expectation should be. Here's another example. This is off of a 60-minute chart. And you've got price accelerating to the downside, extending away from that 20 MA, volume increase, right? Ideally, there's some support to the left, but you've got your changing of the guard. You buy it over the high, stop under the low, and then a nice rally into that targeted area. Now, notice how as you approach the moving average, the momentum slows down. Notice the range of those candles is getting smaller and smaller. That's because the uncertainty is growing. This one was a bit more challenging, at least in my opinion, when it comes to management. It wouldn't have been hard to enter it, obviously. I mean, you get this move lower, it's very easy to see where your entry would have been over here, okay? This would have been your entry. Your stop would have been either here or here. And while it would have never stopped out, it didn't get going right away. And so for that reason alone, it was a bit more challenging to stick with it. At least it would have been for me. But eventually, as you can see, it did work its way higher and would have gone on to that target. Here you've got a climactic sell setup. So nothing changes other than the expectation, really. You've got multiple bars up. And notice right here, there was a bearish changing of the guard right here where it's being labeled. That was a climactic sell setup that just simply never triggered. It continued to extend a bit higher. Then you got the novice gap up, which eventually led to the breakdown below the bottoming tail, triggering the entry. Your stop goes over the high, and then your target is down in, again, the 20 MA area. But if you were initially looking at this area here to trigger a climactic sell setup, you would not have been wrong. But this is why we wait for patterns to trigger rather than just simply anticipating something is going to happen. Should we expect a complete trend reversal after a climactic move? No, I wouldn't say that. It might take a little bit of time for the trend to reset, right? But I wouldn't expect a complete trend reversal. However, there are times where that will happen based on the larger time frame. So if you're getting a climactic sell setup, for example, on the daily chart, and the weekly chart is now into an area where you should see a pristine sell setup forming, then you definitely could see that uptrend on the daily get completely reversed. So it depends. It depends on the larger time frame. But that's a very good question. Now here we have another climactic sell setup as this moved higher from a PBS. Right here is your PBS. You get a nice run higher, extended away from the 20 MA, topping tail, right? You're looking to sell it short, and boom, it falls back down right into that 20 MA. And then notice how this buy setup fails. And this is, as I said, something we would come back to. I mentioned earlier this morning how the first buy setup after a climactic sell setup is low odds. And the same is true in the reverse. The first sell setup following a climactic buy setup is low odds. Because, right, of the fact that the climactic setup oftentimes will create, not always, but will oftentimes create somewhat of a sharp reversal. The retracement could be deep. The fact that it got extended in the first place to the upside, right? The fact that you had everybody piling in believing this was going to go higher and then it pulled back, that creates a bit of uncertainty. So it's going to take a little bit of time to repair, not necessarily the damage, but will repair the confidence to then begin moving back up. Okay. Here is another example of a climactic sell setup where price is running higher from a pristine breakout right here. You've got multiple bars up. Even, I mean, right here, right? Right here, it was a climactic sell setup by definition. Again, it just never triggered. You then got these two extra bars, wider and wider in range, followed by the topping tail, and it closed bearish on its low with volume. That all compiled with everything else strongly suggested it was going to pull back. If there was resistance to the left, even more of a reason. And as a result, you sell it short under this topping tail bar is low. Stop goes over the high of the bar that triggers, and then boom, down into your targeted 20 MA it hits. And here, finally, a 15 minute. So, I mean, we've looked at daily charts, we've looked at weekly charts, 15-minute charts, 5, 2-minute. It doesn't matter. It's about identifying this type of pattern, which is repeatable no matter what the time frame. So here, you get a nice breakout to start things off, rips higher, wide range bars, volume increase, right? You look to sell it short under this topping tail bar's low, stop either over the high there or over the bar that gets you in, and then right down into your targeted area. And as I said before, this is something that you're looking to be all in, all out based on, not something that you're looking to manage differently, trying to get out of it in tiers or in different lots, sell half here, hold on to the rest. I don't personally suggest doing that unless the larger time frame is in your favor, right? If the larger time frame was, say, a buy setup, and you enter a climactic buy setup off of the daily chart, right? In that case, because the weekly is suggesting it can continue to move higher, maybe you sell part of that position into the 20 MA and then hold the rest in the hopes that the weekly will trigger and begin to follow through higher, at which point you will essentially have been in from the low. Um, That would have to be a custom scan if it's going to be telling you the number of bars to the downside. But what you can do is scan through FinViz, I believe, based on percentage away from moving average. So you can scan based on a distance away from a moving average. And that'll give you at least a starting point. All right. So does anybody have any other questions as far as climactics go, or anything? Of course. I mean, it's never a bad time to ask a question, in a sense. No questions? If no questions here, I'll give you guys a 10-minute break. Then we'll come back and we will discuss trading plans. And then after we get through trading plans, we will break for lunch. Okay? So 10-minute break here. Come back, talk about trading plans, and then we'll break for lunch. All right, guys. I'm back. We're ready to go here. So, as I said, we'll talk about the trading plan, and then we'll take a break for lunch. Okay? So that'll be the game plan here for right now. So, obviously, trading plans are extremely important to one's success. Not always easy to know where to begin with trading plans, and that's what, in part, we're going to talk about here. But understand that trading plans are, they're evolving documents. In other words, it's not set in stone. They will change over time as you change as a trader, as the environments change, you may need to make adjustments. And I think that's where traders go wrong in the beginning, is that they think they've got to create this perfect document that they can start following and making money from. And to be honest, there's going to be a bit of a learning curve. So no, don't expect that you're going to just make money right away out of the gate. I mean, if that's the way it works out, great, awesome. That I would hope nothing more than nothing less than that happens. But understand that when it comes to the trading plan, just start with something and let it evolve from there. Don't think that it's got to be, like I said, this perfect written out plan that will never change. So if you're seeking consistent results, which obviously I'm sure you all are, you've got to have rules that determine what to do, when to do it, and how to do it. So some of the sections that your trading plan should address will deal with goals, your daily activities, money management, and what tactics and strategies you're going to be playing. So as far as goals, they must be focused on consistency, not the money. And I know that that is challenging, but if you focus on the money, odds are it's going to be very challenging to make it. However, if you focus on consistency, the money will come. Stay the course, focus on the consistency, and the money will come as a result. You need to establish a style of trading that you're going to pursue, whether it's day trading, swing trading, core trading, a combination of both, what time frames you're going to trade from. And with regard to time frames, understand that what you may think is the time frame that you want to trade from might not actually be the best time frame for you. So just keep that in mind. When I first started trading, I was looking at tick charts, 1-minute charts, very small time frames. And while I could see the patterns, it didn't fit my style. So I needed to adjust. Keep an open mind to what time frame or time frames you're going to choose to use, and determine how much capital you're going to use. Make sure you're tracking your batting average and Sharpe ratio, which tell you how often you're right versus wrong, as well as how much bigger your winners are versus your losses. And also answer the question, will you begin paper trading? And if so, for how long? You don't want to do it for too long because then it creates a false sense of reality. It's better after, a period of time getting comfortable with the trading software and things of that nature. It's better to lose a small amount of real money than risk virtual money, where you don't really have anything on the line, where there is no emotion involved. And also address what your monetary goals are. With regard to money management, it's highly important. You need to determine a maximum loss for the account. Right? I don't suggest you put $50,000 in a trading account and just, lose it all. There's got to be a point or a cutoff where it's like, okay, if I lose this much, I need to really just figure out what I'm doing wrong. Am I trading against the trend? Am I trying to force trades? Am I not following my plan, right? What is going on that is causing you to lose in the way that you're losing? And establish a goal for a winning period of time. I personally don't like having a daily goal to achieve because, let's say it's a Monday, which typically aren't always the best trading days. But let's just say, okay, I have a goal of I want to make $500 today. I want to make $500 a day. Okay, that's the goal. If we hit 3 o'clock in the afternoon and I'm only up, say, $300, I'm going to start forcing trades. I'm going to start looking for things that aren't as good a quality as I normally would look to take. And as a result, I might actually go from being up 300 to break even, or worse yet, down on the day, because I started forcing trades because I needed to get to that $500 goal for the day. So having daily goals, in my opinion, actually can start to have a negative effect or result on what it is you're actually looking to achieve. So if you're looking to make $500 a day, just say my goal for the week is $2,500. I quite frankly don't care how it happens. Maybe I only make $200 on Monday, but maybe on Tuesday or Wednesday, I'm going to make $1,500. Each day is different. What I'm saying is that when the environment is good, when things are firing on all cylinders, when you're taking trades and they're just working, don't stop because you hit a goal for the day. Right? When the traffic is clear, when there are no cars on the road and the path ahead is open, take that opportunity. Right? When there's a bunch of traffic on the road, when the road is congested, when you're just, not moving through as you would want to be, hit the rest stop, in a sense. That's the point I'm trying to make here. And so I don't like daily goals. But you do need to have a certain amount that you're willing to risk per day and per month and per trade. So you need to break those things down. You need to break down that information. So let's just walk through an example here. Let's say you have a $100,000 account and your max loss is $10,000, right? That's where you say, okay, you know what? If I lose 10K, I need to go back to the drawing board. I need to look and say, is it the time frame I'm trading? Is it the patterns I'm trading? Am I trading against larger time frame, not following my plan? Right? What is the reason for these losses? As I already said, I don't like having a goal for the day. Whatever the market's willing to give you, you should take. Some days it will be more generous than others. On the days where it's not being as kind, don't force it. Right? If you don't like how things are setting up, if you don't like the action, then don't trade it. You know, I mean, you're not going to do something that someone else is trying to make you do that you don't believe in. So don't let the market force you into doing something you don't want to do. All right, so with that said, max loss for the day, 600. Max loss per trade, 200, which allows you to take at a minimum 3 trades, assuming they all get stopped out, right? But it doesn't mean that you can only place 3 trades. If you have a $200 max loss per trade and a 600 max loss for the day, right? If you take 3 trades and let's say 2 of those get stopped out and one of them makes $400, then you're break even for the day. You can continue to trade because you've not yet hit that $600 max loss. Okay. If you're having a really good day, instead of shutting things down, what I would suggest you do is instead, have a certain amount you're willing to give back, right? If you're up $1,000, well, say if I give back 200, I'm done for the day. Instead of just saying, oh, I'm up 1,000, I'm going to shut it off. Well, maybe you're up 1,000 for the day because that day is trading really well. Maybe you've got a trend day and things are just moving very, very fluidly. Okay, great. Why walk away from an environment like that just because you're up a certain amount? So, in a sense, you can have a stop loss on the day where if you give back $200, then you're done. Then maybe the environment's changing, you're getting a little overconfident, whatever the case is, but at that point, you're done. Right? So I'd rather see you do that than say, oh, I'm up X number of dollars for the day, I'm just going to take that and be done with it. As far as the tactics or the strategies, as we said before, you've got to determine what trading style you're going to pursue and what patterns you're going to look for and the time frame that you're going to trade from and what time frame are you going to get the macro picture from. And you want to define the strategies, the tactics you're going to be trading in detail. Don't just say, I'm going to play a pristine buy setup on the 5-minute chart. That leaves too much up in the air. You want to define the market conditions. You want to define what amplifiers you need to have and what amplifiers you would like to have. What does the larger time frame need to look like? Right? How much room does there need to be in terms of available target? So all of these things need to be clearly laid out. So for example, if you're looking to get long, the stock's got to be in an uptrend making higher highs and higher lows. It's got to have a smooth rising 20 and 40 period moving average with the 20 above the 40 and an even space between. If you've got those things in place, you're looking to, say, buy a pristine buy setup where once it has formed, you're then going to buy a penny above the prior bar's high, putting your stop below the low of either the entry bar or the prior bar, whichever is lower, and then you're going to look to manage it on up, right? Whether that's selling above the prior pivot high and then using a bar by bar trail for part of the position, or using pivots to manage if you believe that this particular stock has room to continue trending for the day. Whatever the case may be, you've got to determine what management rules you want to use. Maybe if you're holding it overnight and the stock gaps up the following day, you're going to look to sell it at that point, depending on where it's gapping up to, whatever the case is. But these are the considerations that you need to be making. So here we have a pristine buy setup within an uptrend. Higher highs, higher lows, rising 20 and 40, right? Everything in place. You're going to look to buy it over the high, stop under the low, and again, I don't care for this as your target, but your target is going to be at some point higher than the prior high. And then if and when this triggers, right? Because it may not trigger, but if and when it triggers, you then go into management mode. And so here's another example where you've got a couple different opportunities to have played these breakouts. And then here's a buy setup. Pulls back into support, changing of the guard, narrow bodied bar, buy it over the high, stop under the low. And again, manage it on up. As it comes into the prior high, you know there's going to be a reaction. So if you need to sell half, or if you need to sell part of the position there, okay, fine, do so. But see what it does. Hold on to at least some of the position, and then manage it on up as it continues to follow through higher using a bar by bar trail, either on the time frame you entered from, or you could even go down to a smaller time frame and manage from that time frame. And when I say bar by bar trail, for those of you who may not know exactly what I mean, once the current bar finishes, you bring your stop up under that bar. So once the next bar begins to form, you bring your stop up under the prior bar. Right? So once this bar finishes and then this begins to form, you bring your stop up there. So that's what we mean by bar. You're trailing the prior bars low if long, or the prior bars high if short. Okay. Now, at this point, we're up multiple bars, gap up, topping tail here. Looks like it's going to be pulling back in. Yes, with the tail. So the lowest point of that candle. Within reason, of course. I mean, if it's just a huge bottoming tail, then you don't need to give it that much room. But generally speaking, yes, you use the tail as well. And if you really want to get tight with it, you can go to the current bar. So as each new bar forms, you bring your stop right up under that bar's low as it gets underway. But that's, again, something that if you're going to do that, either it's got to have extreme amounts of momentum, or you're more or less just asking for it to take you out. So here's another example: higher highs, higher lows, rising 20 and 40. All pullbacks, breakouts, you should be looking to play long, right? I mean, this again, you want to make sure the larger time frame has room and that it's in agreement, right? The macro trend is up, and assuming those are in place, then you're looking to enter it long on those pullbacks, on those breakouts, for follow through higher, assuming it meets the requirements within your plan, right? If the market's going up, we only look for long trades. As a general rule, yes, you don't want to fight the prevailing trend. Now, if you have something trading on its own page, right? Maybe something caught a downgrade, right? Upgrades and downgrades are given out daily, or earnings, right? So those are the types of things that you may look to trade against the trend of the market because they're on their own page. They're doing their own thing. So in that case, it would be okay. But if you're trading something where it's a market related stock, if it's not doing anything special, if there's no news surrounding it, then yeah, you want to trade it in the direction of the prevailing trend. Okay. So here again, we can see higher highs, higher lows, rising 20 and 40. Again, it's you're looking to buy these pullbacks. You're looking to buy the breakouts. Not everything is going to meet the level of quality you're looking for, and that's fine. I mean, you shouldn't be looking to just take everything and anything. You should demand the highest quality possible. Don't settle for an iffy setup. I mean, this is, after all, your money that you're putting to risk. So don't take that lightly. Demand the very best quality, and if it fits within the parameters of what you're looking for, then by all means, go ahead and take that trade. Now, obviously, not everything's going to work out, but why not try and line up as many factors in your favor as you possibly can? Now, here we have a buy setup, which comes following a nice breakout from here. You had a nice pristine breakout. You could have played that. You then get this pullback. You've got your 40 to 60% retracement. You've got minor support, little narrow range bar, bottoming tail. You're looking at least a 50, 60 point play here. So this is a nice little setup that you could look to play long for a move up into and through the prior high. And again, this is only something you would be looking to do assuming it fits within your trading plan. You're going to enter over the high, stop below the low. You figure out how many shares you're going to be trading based on your risk. And then you've got your target or targets in place. So here we want to find and circle all of the breakouts. Really, I mean, you could say there's one right there, another one right there. But other than that, as far as breakouts go, there really isn't anything else. Maybe you want to stretch it and call that a breakout. Okay, fine. As far as the buy setups, those are more plentiful. You've got one right there that then comes back to retest that low, setting up another buy setup. Then you have another one here and another one over here. So you got a couple different buy setups all within this uptrend. And pretty much every one of these buy setups is also a pullback to minor support, as well as a 40 to 60% retracement. So I'm not going to circle or point to each one of those because in all honesty, we already have. Every one of those buy setups is a pullback to minor support and a 40 to 60% retracement. Again, we want to find the breakouts. Pretty easy to see here and here. Even over here, you could say this was a little breakout as well. So you had a couple little breakouts that you could have gotten involved with. The buy setups in this example or on this chart are not as many. In fact, you really only have one that stands out. The others were these little consolidation breakouts. And then here's your climactic sell setup as price has now lifted away from the 20 MA, 5+ bars, and you've got the gap up and topping tail there as well. So this would meet the definition of a climactic sell setup. Now, we do the same thing when we're in a downtrend. If you're looking to sell short, you want it to be in a solid downtrend. 20 and 40 moving lower with the 20 below the 40, even space between. And once you've got that in place, you're looking to get involved with a pristine sell setup or a breakdown if the case may be, setting up in that way. And then your entry is going to be a penny below the prior bar's low whenever that occurs. Right? If it's a swing trade and you get a gap in your favor, then you could use a 30-minute low. You can wait for a 30-minute low to be established and then take it below that bar as an alternate entry. And then you're looking to put your stop in place. Stop is going to be above the prior bar's high or the current bar, whichever is higher, right? You want to use whichever is higher because that's your reference point of resistance. And then your management can vary from covering below the prior pivot low to covering at least half after a rapid multi-bar decline and then trailing the position on a bar-by-bar basis. Or if you get a gap in your favor, there are a number of different ways to manage. Quite frankly, there is no one right way to manage. It's whatever fits your style, whatever works best for you, as long as you're making money. As long as you find something that is making you money in terms of management, that's really what you can, that's all you can ask for. Nobody can tell you that you're managing positions wrong if you're making money. Period. Okay? And so here's an example. Stage 3 transitioning into a stage 4, right? Here's your initial breakdown, first retracement, sell that short. Now we get underway with a true downtrend, lower highs, lower lows. You can see the various opportunities, some better than others, but clearly downtrend in place. The larger time frame, I've got to imagine, is also bearish. That would add to the validity of this continuing to move lower. And so once you find the trend, you then have to find the setups. And then just manage it in between entry and target or stop. Okay. So does anybody have any questions here as far as developing a plan and some of the things you need to have included in that plan? No? Okay. All right, so I would say that at this point, I mean, we're definitely going to break for lunch here. I would say that we're probably a little bit ahead of time just to give you guys an update on where we're at. We may be done a little earlier here today than we were yesterday. Again, depends on questions, but just to give you guys kind of a expectation for how today is going to play out the rest of the way through. We are going to break for lunch here now. Yep. And then, like I said, based on where we're at in the material, we're probably going to be done a little earlier than yesterday. So if you have any questions at that time, I'm happy to stick around, look at whatever you want to look at. But just FYI, we are probably going to be done a bit earlier here today than yesterday, okay? So with that, doesn't look like anybody's got any questions here, so we'll break for lunch. Again, same as usual, 45-minute lunch break. So we'll come back here and pick things up right before 1 o'clock with, with our next set of slides, which I'm going to actually upload here. For a starting trader, will be better. What would be better to do first, swing or day trading? I would say, which would be better to do first? If you're going to do day trading, I would not suggest using a 2-minute time frame or even really a 5. 5 would be the lowest I would suggest you go. I think 5 and 15 minutes for day trading would be the best. I think swing trading probably would be a good place to start, only because at that point you can see things develop over a longer period of time. It'll give you more time to make the decisions and do the analysis. But if you are going to move into day trading, I would suggest doing it slowly, starting, as I said, with like a 15-minute chart, working down to a 5, and then if you really feel compelled to going lower than that, you can look to the 2 and the 1 minute, but I would not start there. Let's see, can this technique be used to trade the open? Because I notice huge wide range bars at the open. Well, we're going to actually talk about that with the gorilla techniques coming up after the break. But what you can do as far as trading the open is just using a 1 minute, 2 minute, 5 minute bars high. If the gap is compelling enough, then you can do that. Or what you can do is also combine the pattern from the prior day, because a lot of times the way in which things were setting up at the end of one day will often follow through into the next. Is it more forgiving to trade ETFs or individual stocks to get started? I would say ETFs. They're not going to necessarily be as volatile as individual stocks, but you're also not going to have as many opportunities. So it's kind of a double-edged sword there. But if you're talking about just which one is going to be more forgiving, I would say the ETFs will be a little bit more, they'll be a little friendlier to you in a sense when you're just getting started out. But like I said, they're not gonna move necessarily as much unless you're trading those 2 and 3 times leveraged ETFs, which if you're just starting out, I wouldn't suggest you focusing on anyway. Does market sentiment affect the direction of price? Yeah, it does. I mean, if traders are overly bullish or overly bearish, it definitely could have an impact without a doubt. But again, these are things that you will see in the movement of price as well. You'll see, right, if the sentiment is becoming overly bullish, you'll start to see things, volume increasing, wide range bars to the upside. You'll start to see climactic indications occurring. But yes, it will impact the direction of price. Even if it means if things get overbought, even if it means things just go sideways for a period of time before then continuing higher. What do I think about the use of hot buttons in trading? Yeah, anything that can help speed up the analysis or help speed up the ability to execute trades. Um, I think they're more beneficial if you're scalping, if you need to be getting in things quickly and out of things quickly, then they're much more necessary. So if you're looking at those smaller time frames, if you're trying to be in and out more quickly, then yeah, those hotkeys are going to be way more beneficial than if you had to input it all manually, because that time spent doing so could, make the difference between getting in where you want and getting a fill that is going to cost you. So if that is the approach that you're taking, then without a doubt, you should utilize the hotkeys. All right, guys. You're welcome. All right, so we'll break for lunch here. It'll take about 45 minutes. Come back at 1 o'clock, and we'll get started with the guerrilla tactics.